I'm just going to do a quick all right, so we lost a few people, probably, but we'll go ahead and get started again. Good evening. We'll start. Good morning. Evening, not evening yet. We're going to start our next session on financial reform. For those of you who came late, just a couple of housekeeping reminders. The IFE press policy is that IFE events are off the record. Members of the press are reminded of this. If you would like to have any comments from panelists, you may approach them afterward for follow-up. And also that panelists today are here on their own behalf. Their views are their own and not necessarily that of the respective organizations. With that, I will hand it off to David Martin, who will be starting us off today. We're going to have 3 presentations, 15 minutes, 15 minutes, and 15 minutes. At the end, we'll have 15 minutes of Q&A. We won't have a moderator. We won't have index cards. So just shout your questions out, and the panelists will answer from there. Thank you.
Hi, I'm David Martin from AllianceBernstein. I think I've sort of entitled this one, The World According to David Martin. And as a former chief risk officer and now working on government affairs, because we probably all have the government as our partners today. So I entitled this, How Regulation and Government Action Will Shape the Capital Markets Landscape. And what I wanted to do is first give you a macro perspective as I see the world and what this financial crisis has done. So the first, there's winners and losers in every game. If you take a step back, probably China did the right thing in terms of stimulating their economy in terms of infrastructure. U.S. probably came out okay, and maybe Europe's going to be the big loser here as one major viewpoint. And then if you take a step back and you say, okay, I always talk about the discipline of debt. People who go into that discipline come out of it with a different perspective, but certainly see a lot less free expenditures. You see a tighter rein. That's also going to have an impact on consumption and growth. Now, we also think about this increased political change that's happening and the backlash. Now, most people say in Washington, D.C., that it's really Wall Street against Main Street. And people think about it in very different ways. So if you look at Wall Street, and I'm going to be a little sort of out there on this one, but I'm just trying to illustrate a point. Wall Street says, look, we did a trade, we borrowed money, we paid you back with interest, we're done. Let's just move on. Main Street says, hey, we saved your life, you owe us forever, we have more votes than you, and this isn't going to happen again. So things got to change. So you have to look at it from the perspective in terms of where people are coming from. And that will have an impact. There could be because of lower job opportunities, more social unrest. You will have a backlash against business, and you will have potential for change because people are not happy. If you look at the legislative developments, okay, well, one of the things that I keep thinking about is retirement. You have an aging population. That problem did not go away. And that problem has just been accelerated in terms of the impact that this has had on people's savings for retirement. So you could see, and I'm not saying tomorrow, but you could see over time a real wave of legislation in terms of retirement benefits. And lastly, which I think is a very, very important topic, and particularly germane to risk managers, is this trade-off. What we are doing is trading off lower growth for some perceived safety net. So if you're going to have more safety and you're going to restrict, the flow of credit, you're going to have slow growth. So let's just explore that a little bit more in terms of low growth. Okay, I do think that the engine, asset-based finance, not what it was, maybe hasn't been, maybe ground to a halt is a bit too much, but it's not where it was, and it's going to take a while to come back. Core credit, very difficult to get these days. Look at the amount of people buying houses and the difficulty they have. Now, the next point I think is an interesting one. When you have more government intervention, and you're uncertain how the government's going to react when you come out with a new product, and you're uncertain how the government's going to react when you do something, okay, that's going to create a higher level of uncertainty. that's going to create a roadblock. That's going to create. It's going to put a stoppage to some point in terms of new creativity, new ideas, and bold things. I also think that because the developed world markets will be so highly regulated, that there'll be a huge growth exponential in emerging markets, and you'll see more and more growth in that area. And lastly, when you start proprietary trading, say what you want, but there's a lot of liquidity that comes into the market because of that, and that is going to be diminished. Also, if you take a look at the ability of investment banks to, they have the ability to lever themselves up, and as a result, they can do transactions that smaller players cannot do, that there might even be better spreads as a result of all this, because there'll be a little less liquidity, but a lot less competition. Now, in terms of this perceived safety net, so if you're going to trade off growth and you're going to do that for more safety, do you really have the safety? So the first point I'd like to just throw out there is that has risk-based capital worked? If you look at the history over the last 10 or 15 years of regulation, it's all risk-based capital. It's, have more capital to take care of risks that you're not even, existing risks that you haven't thought of. It's all based on risk capital. Have more capital. Well, did more capital help? So if you think about, let's say, liquidity and liquidity risk, did more capital help liquidity? So if you wanted to sell your house at 3 a.m. in the morning, and you woke up and took a sign and you put it on the front lawn and said, house for sale, what would the liquidity be at 3 a.m.? Even if you had a lot of capital, would that help you? So we need to think about capital in a different way, A, and B, is if you have your whole legislative approach to having more capital, is that really a way of creating more safety in the system? Maybe not. I think the second point is if you have to have more capital, it's assets minus liabilities equal capital, right? So if you have to have more capital, and one way of doing it is having more leverage. So to the extent that we look and say, well, leverage is bad, but capital is good, but if you want to continue the same level of business and you have to have more capital, well, you're going to have to increase something, right? And that might be leverage, and you might see much more leverage in the system, which might not have the safety that you think you're going to have. Now, this is very controversial, the next point, because people over the last couple of years since Lehman have said, oh man, counterparty risk, whoa, off the charts, very important risk here. But, well, one second. One of the things I think about when I think about counterparty risk, I call it entanglement risk. The situation where you have a counterparty like Lehman, you have some assets with them, you get stuck and you're entangled and you can't get them out. Okay? Now, if there are orderly, if we're going to have a world coming up with this new financial regulation of orderly dissolutions, we can't let Lehman happen again, so we're going to backstop it. I mean, how? And we're going to take all the collateral and we're going to put it in a depository, third-party depository. So we're going to try to reduce this entanglement, and we're going to reduce the amount of kind of exotics that you could do and sort of standardize things. Does counterparty risk go up or counterparty risk go down? So as a result of all this, maybe counterparty risk becomes less important. And the last point I'd like to make is, if we look at hedge funds, there is a process in the way where hedge funds have become more and more institutionalized. And what do I mean by that? They have risk managers, they have compliance officers, they have infrastructures, and they have large amounts of assets under management, larger amounts of assets under management. And if you want to be acceptable, what is Willie Sutton robs banks because that's where the money is? Well, if you want to get AUMs from institutional investors, you need to have certain things, right? Because an institutional investor is not going to take large amounts of money and give it to someone that doesn't have the proper safeguards, the proper third-party providers. So what's happening is that the hedge funds are becoming much more institutionalized and much more client-friendly to institutions who have all this money they want to give them. Well, in the case of the last 2 years, what we've seen is that hedge funds have become more and more institutionalized, and this trend will accelerate. And the legislation will help it accelerate, because if a hedge fund is going to be regulated by the SEC and it's going to have to report to the SEC and there's going to be disclosure, okay, you're going to see this process even speed up even more. So I talk about this impact of financial reform, and there is a trade-off of lower growth because you're not going to have the credit formation or the innovation as quickly as you had before. But you're not going to have the safety or the perceived safety that most people think, because it may be illusionary in a sense. And lastly, I just wanted to conclude with the result of this financial reform. And it really relates to the supervision. First thing, I would tell you that in terms of the legislation, that train has long left the station, and there's very little any of us in this room are going to do to influence it. What's really going to be the battleground, or the place where people are going to focus on over the next 6 months to 2 years, is taking the legislation and the process to making it regulation. Because how you interpret what Congress meant, okay, and putting it into regs will have an enormous impact, okay? And that's where the battlefront will be. Anybody that's good at government affairs, okay, knows this, and will be focusing on the people who are going to make the legislation into regulation. And let me tell you something, the government doesn't have enough capability to do that. They will have outside law firms do it, okay, and there'll be lots of input that will come in terms of making that legislation into regulation. Second point, make no mistake, hedge funds, derivatives, securitization, private equity, consumer finance, rating agencies, and exchanges all will be impacted. I could talk to you, I could take questions in terms of each one of them, how I think it might play out, but each one of those players are going to be impacted. Now, you have not seen enforcement in the United States the way you're going to see it. If people thought it was bad in Europe with the FSA, okay, you haven't seen anything yet. I think you will see the SEC. I think you will see all the regulatory agencies become much more stronger in terms of their pursuit of criminal investigations, in terms of the persecution. You're going to see a much different environment. I always like to say that every financial crisis needs to see some villains. You need to see somebody, with their hands cuffed being marched out. Okay, that picture, okay, happens in every financial crisis. We haven't had enough of that. You will see more and more of that kind of activity and that kind of approach. Now, the next one I think is interesting. I say risk management will finally get a voice at the table. My friend Tom Donahue says, well, wait a second. Can you be an ornament? Can you have a seat at the table, a voice at the table, a vote at the table, or a veto at the table? I just thought it was so interesting. Thank you, Tom. The point is that what about risk management? Where is risk management in the process? Is it built into everything that we do? Will it have a bigger say? What will change as a result of this crisis? I think there's going to be huge changes. The last point that I'd make is that the major change is going to come in the following front. And it sort of parallels what was said at today's earlier session. I think boards will become much more proactive. They're going to need to understand the risk exposure. They're going to need to understand risk relative to earnings, relative to capital, relative to appetite, and relative to long-term sustainability of the company. They're going to have to think about risk management in terms of organization, in the sense of, are risk managers really empowered? Is risk management inherent in every strategic decision, okay, and has risk management integrated into everybody's job. So that is sort of a summary of how I see risk management in terms of how it impacts the capital markets, its regulation, and sort of David Martin's view of the world going forward. Thank you.
Let's see if I can get this to work. Well, my slides are really not all that important, but so I'm Connie Volstad. I'm the CEO of ISDA, the International Swap and Derivatives Association. I have just come back to work after a couple of years of retirement. I was on the board of a credit reinsurer and saw the most ungodly pieces of risk that I'd ever encountered. I had about 30 years or so in the financial services industry, and when I got a call from the ISDA board asking if I wanted to come in a senior position, I was delighted to do that, and I'm delighted to be here. ISDA, by the way, has been around about 25 years. We have 850 institutional members in 50 countries or so. We work on a number of derivative-related projects, including a lot of infrastructure building that we do in conjunction with the various regulators around the world, and there's actually quite a lot of work that's been done. I do have a background in derivatives since the early 80s. Long before ISDA was around. I used to consider myself to be a little bit of a financial engineer, I guess, although back then we called ourselves geeks. I hope that ISDA can get more involved with the Association of Financial Engineers, because I think there's a lot of synergy there. I'll be talking today about a pretty mundane topic in terms of financial engineering. It's what's likely to come out of the U.S. financial, I'll use the word loosely, reform that's going to probably be signed in the next few weeks. By the way, experience in markets and derivatives does not give you the proper training for dealing with politicians. I'll look at two scenarios, if I can. Oh, I get it. No? Two scenarios. One is what I call a moderate clearing scenario, and this will be mandatory clearing for certain items for certain counterparties, and it also require some exchange trading, and I'll go through that. The second will be a more severe scenario for both clearing and exchange trading. Then I'll talk about a provision that's in the current bill, which is the push-out provision from Senator Lincoln. There's a very good possibility that that will itself get pushed out, or it'll get phased in over a couple of years. I'll spend a bit of time then about the unresolved risk issues that the financial reform is just not addressing, or not addressing properly, and then conclude. So, if I can, first, a moderate clearing scenario would require that the vast majority, well, I'll look at a scenario that would be something that would occur about 3 years hence. In 3 years, I would imagine that the vast majority of all derivative products will be clearable. Right now, interest rate swaps are clearable, and credit default swaps are clearable. By the way, I probably would surprise you if I told you that the dollar amount of interest rate swaps that are currently being cleared exceeds $200 trillion. So it's a very, very large number, and that number will go up very, very significantly in the future. We imagine that there will be an exemption for end users, corporate end users, and perhaps for smaller financial institutions. A few years from now, we think there'll be a number of clearinghouses. There'll be one dominant clearinghouse per asset class, but I think there'll be more than one clearinghouse per asset class, although it'll be dominated by one. The exchange trading will be involved standardized cleared products, and they'll be done both on exchanges and something called SEFs, swap execution facilities, which I think can be rolled out in the relatively near future. If we look at the products that will be clearable, as I said, right now we can do plain vanilla interest rate swaps through the London Clearing House. They are working on a number of different products. They'll be working on, and these things should be rolled out within about a year and a half. The risk management, the bankruptcy management is a very tricky thing, and it must be handled with an awful lot of a lot of safety. But they'll be rolling out FRAs, option products. They have some basis swaps that will continue to expand, cross-currency swaps, and probably within the 3-year period, municipal swaps. With respect to CDS, we now can do, in the next 6 months, we will be able to do virtually all the indices and about 200 single-name corporates. Over a 3-year period, one can certainly imagine that virtually all the indices, tranches of the indices, and thousands of single-name CDS will be clearable. In the equity and commodity derivative space, we think that will be largely standardized products. There's an awful lot of bespoke transactions and unusual indices that occur in those products. The exemption for the end users and smaller financial institutions with respect to clearing they'll still have the option to use clearinghouses as a means of managing their counterparty risk, but there won't be a requirement to do that. We think that there will be segregation of collateral both on a bilateral basis and obviously through the clearinghouse. We did some work in looking at the Lehman bankruptcy and studied all of the claimants that exceeded $20 million. And there were, I think, 275 claimants. Several of them were Lehman entities themselves. But if you looked at the non-financial corporations, there are only 5, and the total amount of claims was about $275 million. Not a very, very large number. The biggest was a Swiss aluminum company that was $80 or $90 million. I excluded from that one transaction, the Giants Stadium of all, that got caught up with selling auction rate debt and had a problem with the monoline that was backstopping it. So we don't think that there's a requirement that we don't think corporations should be required to use clearing houses. The number of clearing houses, as I say, now we have the London Clearing House in London doing interest rate swaps. ICE is the biggest clearing house for CDS. There are a number of other clearing houses that have started or are in the works. There are all of the Asian countries or all of the significant countries out in Asia are trying to develop their own clearing houses. And so we see in 3 years' time that we'd have quite a hodgepodge of clearing houses. As I said, I do believe that for each asset class there'll be one dominant clearing house. And the conditions for membership are quite onerous for these large clearing houses. They require that their members, first of all, do straight-through processing so that everything can be done electronically. They also require the members to have significant financial resources. Obviously, a clearinghouse that has $210 trillion worth of contracts needs to have a very, very resilient bankruptcy scenario stress test, and it will require strong members to deliver the resources that would be required. The membership requirements also will typically require a secondment of staff in the event that one of the members goes bankrupt, that staff will be seconded from the members to the clearinghouse so that they can unwind the risk. There'll be rehearsals for these scenarios, and it does require a significant commitment. Finally, the members have to agree to bid on the positions in the event of a bankruptcy of a member. And by the way, in the case of Lehman, I think they had $8 trillion or 8 trillion euro, I'm not sure which, of swaps with the London Clearinghouse. And the Clearinghouse was able to A, hedge the risk, and then B, sell off the portfolio. And they used up just about half of the initial margin that Lehman had posted. So it did not strain the members at all. And in fact, the remainder of the initial margin was returned to the estate. We think that in addition to having the large clearinghouses, there may be smaller clearinghouses that may have less onerous membership requirements, obviously because they'll be smaller, and you might also be able to create clearinghouses where the client collateral requirements will be less than what they might be with some of the other clearinghouses. And if that is the case, then instead of and the collateral requirements for clients are the initial margin requirements. And so if the initial margin requirements are reduced for certain parties to the clearinghouse, then you'll have to find that the clearinghouse would have other capital demands on members. I think the way things are headed, that most of the large investment firms will become clients of members. They will not be able to, they won't want to become members because of the onerous requirements that they would face there. One of the big issues about a client's dealing in a clearinghouse is that the positions can be moved from one member to another in the event of a bankruptcy of a member. This is called portability. And what the London Clearinghouse does, for instance, is they tell the clients of members that if the member goes bankrupt, they will try to move the position to another member. If they fail to do that, they will give the counterparty, the client, its collateral, the net present value of the position back to them. They urge their clients to find a backup member in the event that the member they're dealing with goes bankrupt. Clearly, segregation of collateral is important for the clients of members. They wouldn't go through a clearinghouse if they didn't weren't able to get their collateral back. One of the big issues that regulators are facing, and it's very, very important, is that you don't convert the interdealer counterparty risk and the entanglement that causes, and the interconnectedness that causes. And indeed, that is an issue that the derivatives market has to face. But let's not just move the risk from one of the big banks to the clearinghouses. And it's very, very important that the clearinghouses are constructed in a way that they can survive multiple bankruptcies in a very, very stressful market environment. And it'd be important that they're properly regulated, and indeed that they use risk management techniques during the course of time to reduce the notionals. We've been working with the London Clearinghouse we meaning the industry, to compress transactions. And over the course of the last 5 years, the industry has compressed about $100 trillion of transactions. It's being rolled out now in the London Clearinghouse, and probably 10 trillion or so will be done this year. We're working on another very, very aggressive and process to perhaps reduce notionals in the London Clearinghouse by $100 trillion or more next year. Well, so systemic risks in clearinghouses are something that we need to be concerned about. I mentioned before that standardized cleared products will be executed either on exchanges or swap execution facilities. With respect to interest rate products, we don't think that the products are going to take on the form of futures. We think they're going to just look like swaps. And we think that with interest rate products, there'll be no broken dates. So you'll be able to trade 1 year, 2 year, 3 year swaps on these exchanges or swap execution facilities. and you won't be able to do off-market structures, so that you'll be able to do a 5-year deal at market, but you can't do a 5-year deal at 5% when the market is 3%. The CDS, there'll be no bespoke transactions, and probably there'll be some cleared products that the exchanges will feel uncomfortable about putting on the exchanges, at least in the near term. With respect to equities and commodities, there won't be any broken dates. You won't have unusual indices, price sources, and so on. The swap execution facilities, as I said, are really an extension of what is already available in the marketplace. The inter-dealer brokers all have very, very sophisticated products that enable them to trade, have the dealers trade electronically. Sometimes they impose voice over that, but these systems can easily get changed so that they can be offered to more parties. Furthermore, if you are clearing, if you're an investment house and you're a client of a clearing member, and you want to do a swap in a 5-year, $50 million swap, you go to your clearing member, J.P. Morgan, and J.P. Morgan then goes into the swap execution facility and executes on your behalf. And the clearinghouse would then take the credit risk, and J.P. Morgan would get a clearing fee, and that's all there would be to it. So it would really change the market dramatically for those entities that are using clearing. In addition to the inter-dealer brokers, companies such as TradeWeb, Bloomberg, we imagine. Bloomberg already trades derivatives on the screen. We would imagine Reuters has every possibility of joining that. And of course, the exchanges themselves. We imagine that there will be block trade exemptions, so that if somebody wants to do a $2 billion rate swap or $300 or $400 million CDS, they won't have to go through exchanges. The big question with this is what will be the effect on the liquidity of the markets. I have a trading background, managed trading desks for years and years. I kind of think that market making has a pretty useful role, and market making will have less of a role in this world. It remains to be seen whether or not the liquidity will be reduced significantly or whether it'll just have a modest impact. I think if it's done properly, it would just have a modest impact on the liquidity of the marketplace. In a more severe scenario, we would see that exemptions for clearing would apply only to official bodies, to governments, supranationals, and so on. We think that this would greatly reduce hedging from end users. End users would all have to have enough liquidity to be able to post collateral, meet the margin calls as and when they occur. The severe scenario would also call for the cleared products to go, all the cleared products to go through the exchanges or the swap execution facilities. And this would, I think, reduce significantly liquidity in most of the derivative contracts. If you wanted to do a 4.5-year off-market swap and everybody knew you were doing it and you had to put that through an exchange, nobody would really care. All they would try and do is make some money out of your transaction. In the event that the U.S. bank derivatives activities get pushed out, it looks like they would go into a subsidiary of the bank holding company. More likely than not, the bank holding company would not be able to guarantee the activities of the swap subsidiary, and therefore they'd have to be separately capitalized. And if you're dealing with J.P. Morgan as a bank, you're comfortable with that. If you deal with J.P. Morgan's derivative products company, you're going to demand quite a lot of capital, and the capital that J.P. Morgan would save in the bank would not equal the amount of capital they'd have to post in the new subsidiary. So across the industry, that would require a significant amount of additional capital. Obviously, this would be beneficial to international banks because the Deutsche Banks of the world could still deal in the Deutsche Bank name. I don't think there's a chance in hell that the Europeans are going to abandon the universal banking setup that they have. In a severe clearing environment, it may not have quite the same impact because everything has to be cleared, and so presumably the foreign banks would have to clear as well. Certainly, if they were operating in the U.S. But there is a scenario where the foreign banks could operate outside the U.S. from London, say, and do their derivative transactions with U.S. names, and provided the Treasury and the SEC and CFTC don't object to the overall regulation of the banking system in that country, they might be able to deal with the U.S. companies the way they have in the past. The unresolved risk issues are interesting. We don't object to reforming derivatives, but if you look at what happened in the crisis, we don't know of any significant financial casualty, by that a casualty to a financial firm, that was caused by anything other than real estate exposure. You can start with AIG, go through then Fannie and Freddie, look at the large commercial banks, Wachovia and Washington Mutual that failed, the large investment banks, you had Lehman and Bear Stearns, their issues were real estate. You have the second biters, I call them. This would be Citi and Bank of America / Merrill. Their problems were caused by real estate in one form or another. Look at the mortgage banks. This would be Countrywide, New Century, American Mortgage. These are all, and all the regional banks that have failed. They have been caused by real estate. Look at the monoline credit insurers. That industry has basically been wiped out because of the real estate issues. Look at the mortgage insurers. They've survived, but barely. In any event, real estate to me, is something that caused the crisis. Clearly, people were taking risk in derivative forms, but the crisis was caused by poor underwriting, poor lending standards, horrific risk management. I don't think any of these entities had a risk manager who said, "Hey, what happens if house prices go back to where they were 3 years ago?" "Oh, sir, we fail if that happens." That's the wrong answer. Anyway, this has not been addressed in the financial reform. With respect to derivatives, most of the losses that occurred in the derivative world were in the form of complex products, the synthetic CDOs that were created, and these are addressed a bit. They have to be, all transactions have to be reported and regulated in some fashion, but there's no way of saying how much risk is there and what are the losses given a default. So that's an issue that remains will remain in the future. So in conclusion, expansion of clearing will reduce systemic risk, but it may create systemic risk itself in the clearinghouses. Exchange trading will increase transparency, but it may reduce liquidity. And what hopefully the regulators will do is create rules that balance these considerations in a way that the costs don't outweigh the benefits. Thank you very much.
Good morning. Are we there yet? We're not there yet. I've got a fairly narrow topic that I was asked to talk about, which is what to do about too big to fail. But I think it's not narrow. I think it's at the center of the kinds of things that we need to do in reforming the financial system. And as we get closer and closer to the end of the legislative process, it becomes less and less, more and more obvious, I guess, or less and less clear that we've actually done appropriate reforms. I've got a lower left-hand corner here. I've got a half-hearted disclaimer. I have spent the last year at the Federal Reserve Bank of New York. In case you think that my opinions correspond with theirs, you're certainly incorrect. And so I'm speaking only for myself. If you think back to fall of 2008, there were a lot of extraordinary measures taken, and they seemed at the time like a good idea, and I'd argue with hindsight that they were. You could quibble about whether we should have done one thing or another with hindsight, but I think under the circumstances, by and large, the supervisory infrastructure availed itself quite well. But it did leave us with a really huge problem, which had wandered around the margins and was important for a lot of institutions before that, but it's now sort of carved in stone, and everybody knows that there are firms that are absolutely too big to fail. So what I want to do today is I want to focus on what I think is the source of that policy. I'll survey how I think about the suggested fixes, and then I'm going to stick my neck out and make some recommendations, although it's getting late in the day for that. The way I think about it, the main threat that gave rise to the actions in the fall of 2004 was that supervisors and market participants were extraordinarily averse to the uncertainty associated with a bankruptcy procedure. We know that there aren't good bankruptcy procedures for financial firms. You could argue about whether Lehman was better or worse than we expected, but certainly the uncertainties imposed on Lehman counterparties, combined with the fact that they were funding a lot of their obligations short-term, meant that the uncertainties just caused short-term claimants to run. So we have a very bad bankruptcy process. And there's the danger, and this is particularly true, I think, in the, or at least that was the verbiage, in the CDS market. There's the danger that we have all these over-the-counter exposures. We don't know where they are. We don't know whose alleged hedge is no longer a hedge. And so there's just an immense amount of uncertainty. And the government stepped in and said, we can stop this uncertainty by recapitalizing some of the firms involved. And then the unfortunate characteristic for the legacy is that no debt bears credit losses, and therefore for large firms we have at a minimum severely compromised market discipline. So what's the result of too big to fail? It's the thing that we've talked about in the banking literature for 30 years or longer, and that is the same as deposit insurance. I can remember going to a Fed conference every year at Chicago, and guys from the CME would wander over every once in a while and say, you just don't understand how to run organizations. You got to make sure they have enough capital in the transaction day by day by day by day. And if you did it that way, you wouldn't have any problems. And I think that's correct. That's going to be one of my arguments. But given that we have a set of firms that don't pay full price, and maybe not any price, for their debt that reflects the risk that they're taking, then these large firms have a comparative advantage in taking risks. And that has real sector distortions. Look at the housing bubble. We have lots of houses we don't need. And it also has competitive implications, because just below those too big to fail firms are some firms that don't have the same stamp of approval. And so there are competitive inequities that come about as a consequence. Now, fixing that is really pretty simple in concept. You've either got to devise a mechanism where the firms don't fail, or you've got to define a mechanism where the turmoil associated with failure is acceptable. And I think it comes down to that. And so when I look at solutions to the too big to fail problem, I think of there being sort of a negative externality, that these guys are taking risks that are borne somewhere else to some extent. And so if you look at this graph, the horizontal axis is the firm's risk. The vertical axis is the firm's cost for bearing risk or accepting risk. And you can imagine that there's some sort of socially preferred level of risk. I don't know how to make that come true, but you can imagine that. And you can enforce that socially preferred level of risk either by pricing risk, either with an insurance premium, a liability tax, a capital standard, or by simply imposing a quantity restriction. And you might think of the Volcker restrictions, or moving the CDS trading outside of the banks or into a separately incorporated subsidiary as a quantity restriction. Now, economists like price or fee-based ways to ration scarce goods. And if we actually knew where this downward sloping line was, we could use equally well either a fee or a price, or we could use a quantity. The problem is, suppose you're a supervisor and you're not really sure if the supply of firm risk is the blue line or the red dotted line. Then if you set a fee, you're going to have bounded the amount of excess risk, but you're going to have a lot of uncertainty about where the excess risk will actually wind up, how much of it there will be. So then you say, okay, well, that argues for quantity restrictions, but suppose you can't measure. Suppose the downward sloping line is known, but we have a lot of trouble measuring a firm's risk exposure, either because it's hard at any point in time or because supervisory information lags, and so you're never quite sure where the risk is. So both of these problems, I think, are real for the supervisors, and one of the characteristics of the problem is that the set of activities that a firm undertakes affects either the uncertainty either in the left-hand graph there or in the right-hand graph. So when Paul Volcker first started talking about activity restrictions, I thought that he'd finally gone over the hill, and that didn't make any sense at all. But the more I thought about it, the more I thought that in the context of uncertainty about what the supervisors can see and how well they can measure it, that quantity restrictions, Volcker restrictions, might make some sense. So I think when we talk about too big to fail solutions, we ought to recognize a couple of principles. One is the supervisors have a big information problem. And that gives rise to the notion that maybe a supervised firm shouldn't be doing things that the supervisors can't keep up with. Now, that's a very, sort of deep, we can talk for a long time about that, but I think that that's a pretty important consideration. Second, we've got to ask, as a couple of the speakers mentioned, we've got to ask, well, if we squeeze the risk out of the financial sector that we regulate, where's it going to go? Is it going to go to hedge funds? Is it going to go to civs? Is it going to go to Thailand? And I think we know very little about that, except my strong intuition is that raising capital standards and imposing strong regulations in this country is going to shift risk out of the regulated financial system. So we could have an extraordinarily secure banking system, but a very insecure financial system as a consequence. And I think that's a really important danger. I don't have a very good feeling about how to kind of quantify the trade-offs, but I do have a suggested way to minimize some of the effects, which I'll get to at the end. So I sat down to try to think about all the different ways that people had suggested responding to too big to fail. And they fell into two categories, and I can split them two ways. Some of these things affect the price of taking risk, and some of them affect the quantity of risk you're allowed to take. And similarly, some of the recommendations affect the PD, the probability of a firm's default, and some of them affect the loss given default. So, for example, expedited resolution is supposed to affect the loss given default. A bad thing happens, we have a new and better way, quote unquote, to resolve the uncertainty, and that therefore is a better thing. So thinking about price and quantity, thinking about PDs and LGDs, that's how I conceptualize the possible responses. Now, in the interest of time, I'm going to skip about most of what I talk about, sort of throwing some things out and keeping some things in, and say what I think is important for addressing the too big to fail problem. I think a CCP is absolutely vital. If we beamed somebody down from Mars and said, hey, look at the way we settle trillions and trillions of dollars worth of derivatives contracts, that person from Mars would say, you're nuts. That doesn't make any sense. It ought to be centralized. There are scale economies in evaluation. Now, I know that it's not as clear as that, that there are offsetting costs associated with central clearing. But it seems to me that that's a really important thing for the stability of the too big to fail part of the financial system. I'd also limit some volatile investments. It seems to me in particular that there's an abundant amount of private capital anxious to do proprietary trading and private equity. And getting those things out of the banks, and of course there are only a few banks where those activities matter, but getting those things out of the banks is going to make the supervisor's job a lot easier, and I don't actually see much of a social cost from that reallocation. Now, despite what David Martin said about higher capital requirements, I think the problem with capital requirements has been not that they weren't high enough, but that they're not enforced. That there's a distinction between book capital, which is what the regulations are written on, and market values of capital, current assessments of what the firm is really worth, which the regulations have nothing to say about. And I'll show you some examples about that. So I'm actually in favor of higher capital. I talked about the CCP. The systemic nature is extremely important. I recognize that in principle. I'm sure I don't recognize the details. But I do remember what Mark Twain said, which is you put all your eggs in one basket and watch the basket very carefully. Now, by the same token, it appears that if we get competition for central clearing parties, I think if there's a lot of competition, I think there's a real danger in that. Because one of the dimensions of the competition is naturally going to be reducing margins. So we're kind of stuck between the fact that I like competition a lot. On the other hand, I really worry about, and we know there's big scale economies in clearing and unwinding positions. So I think there are a lot of thought needs to go into that. And I recognize that Mark Twain has something to say about this, as he does, I guess, about most things. The Volcker restrictions, I basically said what I think about that. I think that they're going to affect a couple of firms. There's, of course, a very fuzzy line between proprietary trading and market making. I don't know how to address that qualitatively, though. I think that we should sort of shift the property rights and move to a presumption where there is less rather than more proprietary trading in regulated entities. Higher capital. Okay. Higher capital forces firms to internalize risks to a greater extent. Higher capital is protection for the taxpayer against whatever risk it is that happens to cause the problem. So higher capital has a lot to say in terms of making too big to fail firms, keeping them from exposing the taxpayers to big losses, and reducing the probability of failure of those large firms. Now, at the same time, higher capital standards are going to drive business somewhere else, and we don't know if we can see it there. So I've got to make that caveat, and I'll come back to that. But first I want to make a point about compliance. Here's a graph that one of my colleagues at the New York Fed put together that has 3 lines. The red line in the center goes back to the first quarter of 2004, and it is the average book capital ratio for the 18 firms that were subject to the stress test last spring. That's the red line. It's very smooth. You'd never know that there was a problem. The blue line is the ratio of the market value of those firms' equity to their on-book assets. We could argue about what the right deflator is. But the important point is that starting in early 2007, the equity market value started to tell us that something was going wrong. And there were times after the first or second quarter, after the second quarter of 2008, that the equity market value was substantially below the book value. The green line just tells us the same thing as the blue line. The green line is the CDS spread, and that axis is on the right-hand side. That's the average CDS spread for those same 18 publicly traded financial institutions. Now, lest you think that's an aberration, of course, here's a local company, small local firm. The blue dotted line is their Tier 1 capital risk-weighted assets. I love this line. I particularly like this part of it. After the second quarter of 2008, we know that Citi sold a lot of Tier 1 capital, most of it in the form of perpetual preferred, which had very special idiosyncratic or firm-specific character. But while the firm was increasing its regulatory capital, the market was saying, essentially, we think your losses are larger than that. And so the market value fell. Lest you think I'm picking on Citigroup, same thing happened to Bank of America. And my point is that if you're a supervisor and you are bound or inclined, or whatever the right word is, to regulate according to the blue dotted line, then you can't possibly be keeping track of capital. So we have a sort of set it and forget it capital level, and we have no mechanism whatsoever built into the regulatory process to replace capital that gets lost. that gets eaten up. Now, is the market always right? Of course not. So we're going to have to decide whose mistakes we like better, whose misvaluations we like better. But I would certainly like to see some more market information included in the supervisory process. Now, what's wrong with raising capital? There's the headline wrong, disingenuous argument that the weighted average cost of capital is going to go up immensely for regulated firms, and nobody will be able to get a credit card loan, and businesses won't be able to form. Again, a much deeper issue. The estimates I've seen and the calculations I've done suggest that that's not a very big effect, but that's certainly a politically important effect. I think the really big danger is the third one here. We're going to drive risk into the shadows if we raise capital requirements. So what I'd like to do is let banks hold some of this capital in the form of contingent capital bonds. These, in case you've never heard of them, these are things that are issued with the stipulation that when the market capital ratio gets below a certain level, the debt converts into equity. In other words, when the firm's capital in real terms has, in the opinion of outside investors, fallen low, then we recapitalize or we de-lever. The nice thing about it would be if it were tax deductible. There appears to be some question about how the IRS would treat it. I don't know of anybody who's gotten a ruling on that, but the tax deductibility would be very valuable, because I think what we could do is we could go to the banking sector, the regulated sector, and say, look, we want you to hold higher capital, but we're going to let you hold some of it in the form of contingent capital. But this is not the bargain I want, where the total amount of downside protection is the same from both arrangements. I want a bargain where you can hold 8% common, just making a number up, you can hold 8% common, or you can hold 11%, of which 5% can be contingent, and therefore tax deductible, and therefore doesn't hurt your ROE on the upside, but it does protect losses and absorb losses and protect the taxpayers on the downside. So those are numbers different from what I just said. The point is, I think that we can get a higher downside amount of protection into the banking firms by providing a tax deductible venue. And if we make the conversion or the delevering contingent on market as opposed to book accounting numbers, then we're going to be deleveraging firms at the time when they need it. Now, one last thing about contingent capital. Many of you might be thinking of October 08, when the world had fallen apart and short sales were forbidden, and everybody was afraid that the market was misvaluing firms and misunderstood them. That's not when I want the contingent capital to convert. I want the contingent capital to convert in June or March of 08 and prevent us from getting there. So if the tranche of contingent capital is thick enough, and if you kind of do a mental calculation, suppose the tranche had been 5% of assets, and the tranches had converted in the spring of 08, we wouldn't have gotten nearly as deep, I don't think, into trouble as we actually did. But the point about the contingent capital is that it's a response to the concern that high capital ratios are going to drive things overseas or into the shadows. So those are my three recommendations, and then I end with a caveat or a proviso that says that nothing that I've said, or nothing, if I had more time, that I would say, is going to protect us from the possibility that we're going to have large firm failures. We're still going to require a lot of active supervision, and we're still going to require a mechanism whereby we get firms to worry a lot about their counterparties' risks. Thank you very much.
We'll do 5 minutes of questions for the panel.
I think the Washington view of the crisis is that there was too much risk, not enough capital, and not enough regulation to control risk. I think there's another view, I'll call it the financial lawyer's view, because I'm a financial lawyer, that the fundamental problems were liquidity and credit, and that all the things which I've sort of heard about what we're doing today really don't do much to improve liquidity, and certainly aren't improving the mechanisms for the flow of credit. The Fed is even going to be more constricted than it already is in terms of the pipeline that's available, and I don't hear of any other institutions being created to create liquidity. I mean, do you think that these are the real problems that we have to deal with to prevent another crisis, and we aren't doing enough about them?
I'll start. I don't know if this is on, I'll try to speak up. First thing, I think that anybody who I've ever heard say we need more regulation to prevent another crisis has struck me as saying the wrong thing. Okay, the regulations were in place. All sorts of things could have happened. Supervisors didn't act. Did they not act because they're bad people? No, they didn't act because there was a genuine difference of opinion about what real estate assets were worth. So I think that regulation is the wrong. Extra regulation is certainly not an appropriate response. Second, in terms of liquidity, it seems to me that if firms are all agreed to be well capitalized, liquidity problems largely take care of themselves. So I don't view the crisis, at least from where I'm sitting, I don't view it as primarily a liquidity crisis, but rather a crisis of confidence about solvency, which gave rise or was manifested as people being unwilling to lend to one another. So.
I'll make a comment. I think having more capital, of course, can't hurt. But I honestly think the biggest issue was risk management, that people did not look at what the downside was to the positions they were taking. And the fact that, one position alone that I saw at our reinsurance company was $11 billion slice of CMBS that was all triple B. And if you really figured out the underlying, it was $2 trillion. And your risk was loss given default, you lose it all. But you got 10 basis points. And that one trade would have wiped out the monoline that did that trade. And people just were not disciplined enough to manage their portfolios of risk properly, to give that enough credence. And the regulator should insist on having risk management that is a very, very strong, has a strong source of authority in each firm. If you don't get that, I mean, people are going to it's a herd mentality, and they're going to do something very, very silly again. Again, more capital helps, but if you had more capital, you would not have escaped 2008 and 2009.
I mean, I think from my perspective, you'd have to say to yourself, when does a problem exist? And I would say a problem always exists, but it becomes a problem when you recognize it, that it's there. So that's one point. The second point I would say is, and I agree with the first panel, that problems just don't come out of the air. There are a multitude of things that fail. So you have to, and if you want to fix them, you have to think about, well, what failed and how do you fix that? And at that point, I just raised one interesting thought. I like risk managers that blow themselves up because they get humility. And one of the things I did was hire a senior risk person, person for one of the major rating agencies that was in charge of securitization. And in the interview, I said to him, well, how'd you blow this? Like, how did you guys just blow this? And he said to me, we never thought real estate would go down. It was that simple. And I think that when you think about major problems, I'll just give you one other anecdotal piece. I had lunch with Margaret Thatcher many years ago in Singapore. And I said, how did you go to war, with Saddam Hussein the first time around? And she said to me, don't let a bully push you around. So I just called up Ronnie and we went to war. It was very simple in terms of the thought process and coming down to like principles of how you think about things. And if you think about this crisis, there's just a couple of things, major themes that roll out of it that you got to fix. Like, I'll give you one, the American dream. Everybody has a house. Well, when my cleaning lady and her husband's a baggage handler at JFK, and lovely people, when they put a $500,000 house, I said to myself, whoa, something is not right here. So I just think you got to go back to very simple things and fix those things. And it comes down to what is important. If you think the stability of the deposit system is important, then maybe Glass-Steagall is the way to go on that score. But I don't have the answer. All I can tell you is that it's not one simple thing, A, and B, it's a multiple of things that come back to very simple principles in terms of what you really want to do.
Yes, sir.
Am I supposed to use this? Well, I think there is one simple thing, and you used the word principles. Isn't the problem sort of a lack of ethics and principles? For example, if the mortgage industry was really about getting mortgages in the hands of everybody who deserves to have a mortgage, that makes sense to have a mortgage, that industry would know their job was done, mission accomplished sometime, I don't know, 8, 9 years ago. And we don't, so it isn't part of the regulation an issue of self-regulation? How can we say that risk management wasn't strong enough when the heads of the firms squashed them? Often, many of the risk managers I know were screaming bloody murder, though they didn't have the principles to quit, go to regulators, and go to the press. But the problem is one of lack of ethics and principles, and isn't that the fundamental, simple principle?
I don't disagree with that. I think if you have a large organization, you have to have checks and balances. And it's up to management to put those into place and make sure that the checks indeed have authority. You're not going to, why do you have any laws or any rules at all? It's to avoid miscreants that are going to cause problems.
Yeah, the answer is, the reason you have rules is so that the participants aren't at the whim of the bad guys in their industry. And yet our industry spent most of its time trying to figure out how to get around rules, find the loophole.
But why don't you have rules of saying that the banking system has to have a 75% loan to value on its mortgage portfolio? Wouldn't that sort of thing have stopped 90% of the?
I absolutely agree.
But
but the industry needs to support that, not try to figure out how to.
Well, the industry and indeed the whole economic system, because the banking system was not the only person originating mortgages.
Precisely.
So are you going to say that you want everybody in the world to be good? That's I don't disagree with it, but.
Yes, I want that.
You want that, but
wouldn't I want
That's not reality, though.
but you can't assume that that's going to be what happens.
Absolutely.
Especially when you could literally finance 100% of your exposure in the securitization market.
I don't think we're going to solve this
We're on
question.
the same side.
Let's take another one.
Yeah.
Yes.
Yes, this is mostly directed toward Mr. Volstead. Given the events of AIG where you had issue flows from subs to the parent company, do you see any issues with regulators like the New York State regulator, for instance, with the insurance companies not allowing insurance entities to participate in the clearing venue where you would have the very important concepts that you brought up of segregation and portability of collateral?
I didn't catch all of that question. My understanding is that insurance companies are going to have to clear their transactions through a clearinghouse, provided the clearinghouses can handle the transactions. I'd say, though, that clearinghouses are not going to be able to clear synthetic CDOs, which is what AIG had. And I think that clearing as much of the stuff that you can with major swap participants makes an awful lot of sense.
Just as a brief follow-up, I mean, there is some concern in the industry that any collateral that would be pledged could be rescinded by the interest of the New York State regulators, that's all.
Okay, that's a technical point, but generally the clearinghouses are going to preserve the collateral in the name of the client.
One last question.
Hi.
One last one.
Sure, go ahead.
Go ahead, Miles.
To follow through a little bit more on the mortgage-backed dilemma here, haven't we forgotten the elements to this structure, that there were LTVs in place that weren't like 125 until the politicians forced a change in the underwriting standards, who then were outraged when the thing unraveled?
I don't understand.
It's a political question, so we dodged it.
I think we'll, with that, take a break. Sorry. No political. Sorry, quick housekeeping note. We're gonna take a shorter break. We're gonna start promptly at 11:35 with Andy Lowe. So go